Joins us now on the CNBC Newsline. Haven't been too optimistic about stocks, Mohammed, so clearly you've been right. What do you see happening today?
So today is a new phase as opposed to just a continuation of what we've seen. Initially this was a sell-off based on interest rate fears and based on financial conditions tightening. Today, it has all the elements of also being a growth scare. We talked about Target, we talked about Walmart, we talked about the Fed being late and therefore having to tighten a lot quickly. But just look at the bond market. Unlike the previous sell-off, bond prices are going up. And that just suggests to me that this is a new phase of the sell-off.
Here's the problem, though, Mohammed. If you are starting to price in a slowdown or a potential recession, this growth scare that you talk about, you might want to be going into consumer staple stocks like a Walmart or a Target or a Smucker or a Campbell's Soup, right, that are defensive and that hold up during recessionary environments. Definitely not working today. So what do you do?
So first, you just got to recognize that we are restoring value. The polite way of saying that we went too far on liquidity. We went too far on the notion that growth can remain strong even though inflation was out of control. And now we're recognizing that it's a very different macro environment. What you saw in Target today, what you saw in Walmart yesterday, even what you saw in Home Depot yesterday was all about the macro becoming micro. And that's what the marketplace has finally understood. The bond market was, as usual, ahead of the equity market, and now the equity market is playing catch-up.
So what does that mean? What are we in for?
So, there will be trading opportunities. I put on Twitter on Thursday, I thought that we had sold off locally, and I got out yesterday. Again, I put it on Twitter. There will be trading opportunities, but this is a market that still is very vulnerable. Growth is slowing in the major economies, not just the U.S., but even more so in China and even more so in Europe, and we've got to respect that. It's a different global macro environment, and inflation is going to remain a problem for a while.
So what? So how you should be moving to cash if you haven't already done so? What is exactly the strategy? Because a lot of these safe havens just aren't working. Gold is barely working. The defensive stocks not doing too hot.
The front end has hardly moved today, 2 basis points. The long end has moved by a lot more. There is now value in the front end as a safe haven. Yeah, it's not, you're still losing money in real terms, but it's a good place to shelter until this growth storm passes. I think we've mostly priced in interest rate risk. We mostly priced in tightening of financial conditions. I've been arguing we hadn't priced in yet the growth concerns. We're pricing them. And there's one other, Sarah, that you've heard me talk about is market functioning. Those of us who are looking at the micro of the markets see pockets of illiquidity. So, this is a tough environment, and you've got to respect that.
Where are you seeing pockets of illiquidity, and what would that mean if we saw that expand?
So you see it in a very barbell fashion. You see it in sectors like, for example, what we saw in crypto, where the liquidity disappears almost instantaneously. And then you see it in these very outsized moves in the treasury market. Look how much we moved yesterday. On what news did we move that much? Yes, Chair Powell was somewhat more hawkish, but not to that extent. So even in the liquidity, even in the treasury market, you're seeing outsides move in response to small news. So, to keep an eye on market functioning, because that we really need to contain. That would take us to another world. I don't think we will move there, but something worth watching in terms of a tail risk.